You bought Bitcoin. You didn't sell. You didn't trade. You didn't cash out a single sat. And now a government wants a cut anyway. Not because you realized profit, not because you touched fiat, but because your portfolio number went up on a screen. That's the event. That's the line they crossed. And for thousands of crypto holders in the Netherlands, it's no longer a hypothetical fear. It's policy. A 36% tax on returns, including unrealized gains. So if your coins pump this year and you don't sell, you can still owe a real tax bill. Real euros, real deadlines, real consequences. And here's why you should care even if you don't live in the Netherlands. Because when one developed country normalizes taxing paper gains, every finance ministry on earth starts watching. They copy what works. They recycle what generates revenue. And they rarely ask for your permission. I'm your host, and today we're breaking down the Dutch crypto tax shift that could become the blueprint other countries borrow next. Stick with me, because near the end I'll show you the part that's easy to miss. The hidden liquidity trap baked into this law, and why it can quietly force selling pressure into the market even during a bull run. First, let's strip this down to the core. The Netherlands has passed legislation that moves investment taxation toward actual return in what they classify as Box 3. And the headline that matters to crypto holders is simple. They're aiming to tax actual investment returns at a flat 36%. And for crypto, they're not waiting for you to sell. They're looking at the mark-to-market change, the difference between what you had and what it's worth, the paper profit, the number that disappears the moment Bitcoin dips. If this sounds surreal, it's because for most investors, it is. Most countries tax realized gains. You sell, you profit, you owe. This flips the order. You owe, then you figure out how to pay. Now the timeline. The full system is set to come into effect January 1st, 2028. That sounds far away until you remember how fast policy becomes reality once it's locked into law. 2028 is not a lifetime. It's one cycle, one bull market, one bear market, one surprise crash that turns paper gain into paper loss right after you paid the bill. Before this, the Dutch system already had a controversial feature. They taxed a hypothetical return, a presumed yield on assets, whether you achieved it or not. Investors hated it. Courts questioned it. It was messy. So now the government is saying, fine, we'll tax actual return. Sounds fair, until you see how they define actual for crypto. Because for crypto, actual doesn't mean sold, it means valued. That's the first shockwave. And the second shockwave is what they chose to exempt. Real estate and qualifying startup shares are treated differently. Those assets aren't forced into the same annual mark-to-market taxation approach in the same way. Property investors typically pay when they sell. Startup equity typically pays when there's a liquidity event. Crypto holders? Annual bill. No sale required. That difference is gasoline on the fire, because it creates a two-tier investment world. Slow, legacy assets get time. Fast, volatile assets get squeezed every year. Now let's make the pain real with a simple example. You buy Bitcoin. Your position rises by $10,000 over the year. You never sell. You're still holding. Under a 36% tax on that return, your bill is $3,600. Not from profit you took out, from money you don't actually have unless you sell something. That's the liquidity problem. And it's not an accidental side effect. The government itself acknowledges liquidity risks in explanatory language because they know what this creates. A scenario where long-term holders can be pressured into selling assets just to fund taxes on gains they never realized. That's why critics call it a forced liquidation mechanism wearing a tax policy mask. Now zoom out. Why is crypto uniquely vulnerable to this kind of approach? Because Bitcoin doesn't behave like a savings account. It can rise hard, fast, and then fall brutally. You can be up 200% on paper in a good year, and down 70% the next. Now imagine you pay the good year tax. Then the next year the market dumps. Your portfolio shrinks, but the government doesn't refund last year's tax because you feel sad. Yes, there are loss provisions. Yes, there are carry-forward tools. But those tools don't solve the core problem. You still needed liquidity at the exact moment the bill arrived. And if you didn't have cash sitting idle, you sell coins. That introduces an invisible sell pressure pipeline into every bull market. Because in a rising market, the tax bill rises, meaning the stronger Bitcoin performs, the more holders may be forced to sell a portion just to pay the annual obligation. Do you see the paradox? This policy can punish long-term holding and reward assets that are slower, harder to move, and politically protected. Now, the government did include small relief valves. There's an annual tax-free threshold around the low thousands in return, roughly in the neighborhood of about $2,000 equivalent, depending on the figures you're using. And there's an unlimited loss carry forward above a certain minimum loss threshold, roughly around the mid-hundreds in euros. Those details matter at the margins. Small investors might fall under the exemption. Down years can offset future gains. But for serious holders with meaningful exposure, the main machine stays the same. Mark to market, annual bill, pay up. And if your portfolio is big enough, those concessions are like putting a bandage on a broken bone. Now let's talk about why governments are attracted to this idea. Because from their point of view, it's clean. It captures wealth growth that might otherwise go untaxed for years. It reduces timing games where people delay selling indefinitely. And it creates consistent revenue. But it also creates a new kind of risk: capital flight. Crypto is uniquely portable. Real estate can't move. A business can't move easily. But Bitcoin? It travels with a password. If taxation becomes punishing enough, the highest value taxpayers are also the most mobile. And if they leave, the government loses the exact group they were trying to tax hardest. That's the chess match happening underneath this story. And people are already talking about it. Portugal has had favorable crypto treatment in certain contexts. The UAE is famously attractive to globally mobile investors. Switzerland has long positioned itself as crypto-friendly, depending on canton and structure. El Salvador built an entire narrative around Bitcoin adoption. The point isn't that everyone should move. The point is that for a subset of holders, internationally flexible, financially resourced, this law makes relocation a spreadsheet decision. And the more that happens, the more other countries either copy the tax or compete against it by offering better terms. Now here's the part that makes this story bigger than one country. This law is unusual even relative to Europe. Many European nations lean toward realized gains taxation on crypto, sale-based taxation, not annual mark-to-market for retail holders. So when the Netherlands moves this direction, it becomes a test case. Does it raise meaningful revenue? Does it cause political backlash? Does it trigger a wave of residency shifts? Does it reduce retail participation? Does it push crypto activity into more opaque channels? Every regulator watching this wants the answer, because if it works, they'll want their version. Now add one more layer. The global conversation around crypto taxation is heating up everywhere. In the United States, debates about taxing unrealized gains have floated in political circles at various times. International bodies like the OECD push reporting frameworks. Governments want visibility, they want compliance, they want revenue. Crypto is on the radar because it grew from fringe to mainstream faster than tax codes can adapt. And when systems lag, governments often overcorrect. They don't slowly adjust. They slam the door and collect what they can. That's why this matters. Now let's look at the growth story that's fueling the government's appetite. Dutch crypto exposure has expanded dramatically over recent years. Indirect crypto investments by companies, institutions, and households have been reported to rise from tiny levels in 2020 to much larger figures by 2025, over $1 billion equivalent in some estimates. That kind of growth changes everything. When an asset class is small, governments ignore it. When it grows, they regulate it. When it becomes politically visible, they tax it. And crypto crossed that threshold. Now, it's also true that crypto is still a small slice of total securities holdings in the grand scheme. But governments don't tax based on share of the total. They tax based on rate of growth and ease of capture. Crypto is easier to target than a complex web of legacy wealth structures. And retail holders are easier to squeeze than institutions with teams of advisors. That's the brutal reality. So how has the crypto community reacted? In 3 words: loud, angry, alert. And the criticism clusters into 4 big fears. First, forced liquidation. If you owe taxes on gains you haven't realized, you may have to sell assets you wanted to hold. That undermines long-term investing and turns HODL into sell to pay. Second, uneven treatment. If property is not treated the same way, and startup equity isn't treated the same way, then crypto holders see favoritism. Not just unfairness, a structural bias toward established asset classes. Third, capital flight. High net worth holders, entrepreneurs, and globally mobile investors can leave. And crypto makes leaving easier because the asset doesn't care where you live. Fourth, volatility mismatch. Bitcoin's volatility makes annual mark-to-market taxes especially dangerous. You can pay on a peak, then watch the asset drop, then carry losses forward, while your liquidity is already burned. That's the nightmare scenario. And it gets worse in one specific situation. Imagine you're up big in a bull market. You pay a large bill. Then the market crashes hard. You're left with losses and a depleted cash buffer. Yes, you can carry forward the loss, but you can't unspend the money you already paid. That's the kind of policy design that feels survivable on a spreadsheet and brutal in real life. Now, to be fair, officials have hinted they want to move toward a realized gains model long term. They've acknowledged the current approach isn't ideal. But their argument is basically, we need a workable system now, and this is how we protect public finances. Translated into plain English, we know it hurts, but we need the revenue. And that statement should make every crypto holder pay attention, because it tells you exactly how governments think about crypto in the next decade. Not as a hobby, not as a fringe experiment, as a taxable base. Now let's get to the part that matters most for you watching this. What should a crypto investor actually do with this information? First, if you are a Dutch resident or could become one, you need to treat 2028 like a real deadline. You have time, but not endless time. And the decisions you make before a law takes effect, how you structure holdings, what vehicles you use, how you plan liquidity, can change the outcome dramatically. Second, know your numbers. If a system taxes annual changes, you need a clean record of cost basis, portfolio value, and potential tax exposure. Going in blind is how people get surprised, and surprise is expensive. Third, take legal optimization seriously. This is where professional advice matters because different structures can change treatment. The point is not hide, the point is plan. If you wait until the rule is active, you are playing defense with no time. Fourth, respect the exemptions and loss tools, but don't overestimate them. If you're small, the exemption may protect you. If you're large, the loss carry forward helps in down years, but it does not eliminate the need for liquidity in up years. And liquidity is the core issue. Fifth, for globally mobile people, the residency question becomes part of the conversation. Not the only part. Life matters more than taxes for most people. But if you're already flexible, tax policy becomes a serious variable. Now here's the cliffhanger most people won't see until it hits them. This kind of policy changes market behavior. It can create systematic selling. Not because people are bearish, not because the asset is weak, but because the tax calendar forces actions. When you tax unrealized gains annually, you create a predictable window where some holders must raise cash. And how do they raise cash? They sell. So in a strong bull market, the very success of Bitcoin can trigger forced selling by holders who aren't even trying to exit. That's a structural friction. And once traders know it exists, they front-run it. That's how policy quietly becomes price action. Now I want to hear from you. Do you think taxing unrealized crypto gains is fair, or is it a slow-motion forced liquidation strategy? And second, if your country tried this next, would you adjust your portfolio, or would you consider changing residency if you were able? Drop your answers in the comments. I read them, and your takes shape what we cover next. Here's the bottom line. The Netherlands just pushed a boundary between taxing realized profit and taxing paper value. And once that boundary moves in one country, the global conversation shifts, because policymakers are always hunting for templates. If it raises revenue, it becomes contagious. If it triggers backlash, it becomes a warning sign. Either way, crypto holders don't get to ignore it. You don't have to panic, but you do have to pay attention. Because regulation doesn't arrive with fireworks. It arrives with paperwork. And by the time the bill hits your inbox, the debate is already over. If this breakdown helped you see the bigger picture, subscribe. One click, short and simple. And share this with one person who holds crypto, because this is the kind of change that catches people asleep. Stay sharp, stay liquid, and always protect your wealth.